Hi, everybody. Thanks for coming to this talk, Experiments for Reserves Endgame. Can we build inflation tracking portfolios from ETFs? There's three of us who are going to be talking to you today. My name is Chelsea. I am the research manager at Confusion Capital. This is Gina. Gina is our lead macroeconomist. And this is Eric. He is our treasury manager. And the three of us have been working together on a project that the research team has undertaken in service of solving some practical challenges for understanding exactly what steps we need to take to achieve reserves end goal. So, what is reserves endgame? As Nevin said, we want to eradicate inflation. And in particular, what we're trying to figure out is how to give the world an asset-backed currency that is resistant to inflation and reliable during the debasement of fiat currencies, especially in the case that should happen to the US dollar. So we are talking to you about this experiment that we're running today about can we create a portfolio of assets that tracks inflation. That word is really specific, and we're going to come back to that. We want to track inflation as closely as possible. Why are we doing this experiment? Well, about 2 months ago, we were tasked with learning by doing. We were told, let's force ourselves to make some specific decisions about asset allocations, actually invest them with a small amount of money, and then track how we do to make this idea of an asset-backed currency that tracks inflation concrete so that we can begin to learn what we need to figure out to do this in the end game. So I guess I should mention at this point, we're really excited for you guys to actually talk to us at the end of this presentation. We're going to try to leave a lot of space for questions at the end because this is not a thought experiment. There is going to be money put into these portfolios that we are describing to you. And so if you spot any issues, if you see room for improvement, if you have suggestions for where we should look, we would really like to hear it now. So you might wonder, well, why are you just trying to track inflation? Why not just outperform inflation? That seems like more is better, right? Well, as we've been saying for the past couple of days, we want this to work as money. So that means it can't be a speculative instrument. We don't want people to hold it. And it also has to be reliable over the short and the long term. So it needs to be as inflation-proof next week, next month, next year, next decade as we can make it. So we're going to do just a little check for understanding now that I've given that intro. I have a chart here. You're going to see more charts like this in our presentation. The dashed line is a portfolio that grows precisely with inflation. So if you took $10,000 at the beginning of 2023 and invested it in this hypothetical portfolio, the dashed black line is exactly how it would grow. The colored lines represent hypothetical portfolios that grow at different rates. So this is a participation portion. If you think that the orange line is the most successful portfolio for our purposes, I would like you to hold up one finger. And if you think that the blue line is the most successful portfolio for our purposes, I would like you to hold up 2 fingers. Good job, folks. It's almost like we've been talking about tracking inflation for 2 days. But we emphasize this, joking aside, we emphasize this because we've noticed as we've designed this portfolio that it's actually, we're very conditioned to seek overperformance. It's very difficult to hold in your head the goal that you don't want to overperform as much as you don't want to underperform. Tracking inflation requires you to sacrifice overperformance as well as minimizing drawdowns. So keep that in mind as we move ahead. For designing these portfolios, what components and benchmarks are we going to use? Eric's going to go into a lot more detail about the rationale for the limits that we've put on ourselves and the data that we're working with. But for now, I just want you to know we're using ETFs only. So no equities, no specific stocks. We're just using ETFs. And we've excluded any ETF that relies heavily on US government debt for the purposes of this experiment of designing a currency that would be reliable in the case of the debasement of the US dollar. We're also just hand-waving away questions of tokenization. Billy and Andrew are going to have that handled in no time. And so I'm sure that all the regulatory clarity will be there by the time we design this portfolio. We're only tracking US CPI at this point, just because it's the easiest place to start. And so having these limitations, the idea is that this lets us test methods with smaller data sets and begin to make comparisons to other portfolios so that we can understand how we're doing. So what we're going to introduce you to is two approaches that we've taken to portfolio design: the intuitive portfolio and the programmatic portfolio. And each of these leverages sort of the different expertise that we have in our team and offers two different approaches that we could follow going forward. So the intuitive portfolio is designed sort of answering the question, what portfolio would an expert asset manager like Eric actually design? And can it track inflation closely? The programmatic portfolio is a more statistically driven data mining approach that asks, how can we design a programmatic and decentralized portfolio that meets the same goal, that tracks inflation closely? So Gina and Eric are going to walk you through the specific designs of these, but I want to sort of prime you with some key differences. So the intuitive portfolio it's essentially actively managed, right? It's designed by a human. It can be forward-looking. It can make value calls and judgments about what's going to happen. So it can be responsive to world events. It can be responsive to inflation projections, and it can make judgment calls. The programmatic portfolio is essentially backwards looking only. It cannot forecast at present what is happening in the future. So all it is doing is looking backwards to see how assets behaved in the recent past and designing portfolios from that. We did notice as we designed these that this isn't sort of a blind experiment horse race, that there was much conversation between the two portfolios as we designed them, and assets were surfaced from both approaches that ended up informing the others. So, spoiler alert, we're just going to tell you at the beginning how the portfolios do. If you look at this chart, as I said before, this dashed line is the growth of a $10,000 invested that precisely tracks inflation. And the two blue lines are the intuitive and the programmatic portfolios that we've designed. So this line here at the top, that's the intuitive portfolio. And then the one that is kind of hovering here in the middle, that's the programmatic portfolio. Right here, I'm showing them plotted against some different popular evergreen strategies. You have Dalio's all-weather, all-seasons portfolio, one for minimizing fat tails. You have the Yale endowment strategy. Now, just to be clear, I'm representing those strategies. We don't have access to the actual fund data, so these are popular implementations of those strategies using ETFs. But anyway, you can see that the two portfolios that we've designed work differently. The intuitive portfolio is kind of trending up here, and the programmatic portfolio is following the same sort of frequency, I guess you could say, as the popular evergreen portfolios. So I think I didn't say this, but an evergreen portfolio is just a way to invest money long-term without having to make short-term adjustments and predictions. And so it's kind of trending along, but it's tracking pretty close to that inflation line. So this is noticeable even if we change the start date. Again, the two blue lines are our portfolios. And it's also noticeable that their performance is different than existing inflation-focused ETFs. So there are some on this chart that you'll recognize from earlier talks and roundtables. This STIP ETF is the one that Larry highlighted in his talk, and Michael had in this INFL ETF in his roundtable just before this. So basically you have the US government debt-focused TIPS ETFs in orange, green, and red, and then you have inflation. This is a portfolio that's designed to pick inflation winners, and you have sort of a interest rate options driven strategy as an inflation hedge down here. So this one's kind of interesting because ours are in the middle of these two strategies. So with that introduction, I'm going to pass the mic to Eric, or he's going to bring his own mic.
Thanks, Chelsea. Hi, everyone. I'm Eric. I'm the treasury manager at Confusion Capital. Before I got into magic internet money, my previous life was working at a large asset manager for several years, where I was an analyst covering mostly energy and industrial equities. before we get into the specifics of the intuitive portfolio, I just want to talk through some of the global constraints. Number one, we instituted a rule where any portfolio had to always hold at least 5% in Bitcoin and gold. And this is predicated on the view that, we're building this portfolio as an insurance against the potential of rapid currency debasement. And so in those situations, when debasement happens, they happen very quickly, and assets and equities reprice very quickly, in a very short-term basis. So, the insurance policy has to be in place, because if you're trying to buy things or you're trying to position yourself as that move is happening, you're going to miss the majority of the move, and it's going to get very messy. And so, we view these as good hedges, and so we want to always have some portion of the portfolio dedicated so that we're protected in these black swan scenarios that we can't properly forecast. At this point, we're not using any U.S. Treasury debt in the portfolio, and that's partially predicated on a view that we don't want to be exposed if there's any form of soft or hard restructuring of the U.S. Treasuries. We don't use derivatives because derivatives generally are expensive, complex, and difficult to maintain. And we don't want to use actively managed ETFs because we don't want this black box scenario where a manager is exercising discretion and we're not really sure how they're going to rebalance and change the position of their underlying assets within the ETF. We just want really simple ETFs that express really simple, that are passively managed, that are very predictable and easy to implement. And on the last side, we're not doing any insurance funds because we want free entry and exit. So there's not going to be a situation where we set aside excess profits and top up for the portfolio if it's lagging inflation for different periods of time. Oh, there we go. On asset weights, nothing can be more than 25% of the total portfolio. Nothing can be less than 5% of the total portfolio. And as a whole, we can't invest in anything where we're potentially more than 1% of the ETF's AUM, just to make sure that we're always using the most liquid ways of expressing our view. And whatever we have in the portfolio is big enough to matter, but not big enough to completely determine the outcome of the overall portfolio. So again, what is the objective of this versus more traditional portfolios, right? Traditional portfolios, whether they're capital, they have a capital preservation mandate or they're looking for alpha, it really comes down to the fact that they have to make money because they have to make money to adequately compensate clients and also adequately compensate the people that are working to manage those assets. Since those are usually very educated people from good backgrounds that need to be paid a lot of money. What we are trying to do, we are not trying to do that because our goal is to have a stable unit account or an alternative safe haven versus fiat currency, so someone can come in and say, hey, I want to park some of my wealth in here because I want to be able to maintain my purchasing power until I figure out what to do next, right? What we don't want to do is dangle the potential carrot that, hey, this is a speculative instrument and you should come into this with the intent of making money, because that really fundamentally changes the product and changes the type of parties that would be interested in it. So how do we construct the intuitive portfolio? A lot of it is by market intuition and experience, right? We know historically that during periods of high inflation, assets like gold, metals, and energy perform well. And then we're also making the call that Bitcoin as an asset class has crossed the Rubicon and become this, become a universal store of value and a relative safe haven. And it's kind of reductive because really what it comes down to is I'm saying, like, during inflationary periods, I want to own oil, I want to own shiny rocks, and I want to own digital money, right? Magic digital money. But it historically, these are the things that have proven to show positive correlation to periods of elevated inflation. And so, we're just leveraging this collective experience and building out a portfolio and then backtesting it to see how it does over certain periods. So as we're constructing this portfolio, we're basing it on several things. One, we're making the assumption that inflation is going to remain sticky for a variety of reasons, right? Obviously, we have geopolitical tensions in the Middle East. We have all sort of these undercurrents within the U.S. that suggest that inflation will be stickier than expected. And then we're also, maintaining optimism in saying that we don't necessarily believe that the debasement of the U.S. dollar is certain, but the possibility of that now is definitely not zero, and we have to be positioned accordingly. So that means we're going to take a barbell approach, where on one end of the barbell, most of the assets are going to be dedicated to short-term debt with productive U.S. corporates. So we have a consistent baseline return of, let's say, mid to high single digits. On the other end of the barbell, we have things like Bitcoin and gold that really serve as that insurance policy, so that in these extreme movements, in these extreme periods of high volatility, we have downside protection on other portions of the portfolio, and then we get compensated. We're appropriately compensated when expectations around inflation are higher than expected or become completely unanchored. Thanks, Chelsea. So what does this portfolio look like? Well, 25% of the portfolio is in short-term corporate debt, and this largely consists of either fixed or floating rate bonds. We have about 7.5% allocation to U.S. equities, and that's predicated on a view that yes, like in a dollar debasement scenario, U.S. assets probably won't do well. But if I think about U.S. in the context of AI, in the context of technological advancement, and all of these really relevant things, the U.S. is still a very, U.S. companies are still very dominant, and it's very hard to ignore them, right? But outside of that, we have about 12.5% of the portfolio exposed across emerging and developed market equities outside of the U.S., and that's predicated on the view that in this scenario, sovereign wealth funds, asset managers, investors will look to allocate elsewhere. 7.5% of the fund is in uranium, the uranium ETF, and that's our expression for energy. And we're using that instead of traditional oil because, again, when we look at the next leg of where the incremental energy demand is coming from, right? Electrification as a mode of transport has crossed the chasm, right? If you look at things like Chinese auto sales, more than half of Chinese auto sales are now EVs. When we think about where the incremental demand for compute incremental demand for compute is going to continue to grow, and that means there's going to be a greater call on electricity. Traditional energy assets like coal and natural gas have their own limitations, and our view is that as time passes, nuclear becomes the best option for to fulfill that incremental energy demand. And then we have 10% in gold, 15% in Bitcoin for the aforementioned reasons, and 20.5% in the Swiss franc, which historically has been this, relative safe haven currency. So how does this portfolio perform? Well, if you started in 2020 and allocated $10,000 to this portfolio, at this point in time, it did no rebalancing. As of May 2025, you would have a more or less 2x your money. So the portfolio is successful in the sense that it does perform well in in inflationary periods, and it does track inflation directionally, but the major failure is you have these major periods of volatility, right? In this initial period, it way outperforms inflation, and then through 2022, at the outset, at the outbreak of the Russia-Ukraine war, you have a major realigning of risk assets, and it suffers a pretty material drawdown before recovering to all-time highs, right? And ideally, what we want to do in this situation is we want this part of it to come down, and we want to minimize the drawdown that happens here. So we want this to push up and just track very closely to this line. Because again, the goal of this asset is not to dangle the carrot of speculative returns and tell people you can 2x your money. The goal of it is to say, hey, if you put your money in here, you're going to be able to maintain your purchasing power through what are very volatile, unpredictable periods. And so what does that require? It requires the ability to programmatically rebalance the portfolio and just really take a systemic approach to how assets are allocated. So in periods of outperformance, we're making the adjustment to de-risk assets and ensure that during more volatile periods, we're not taking outsized drawdowns. And Gina is going to talk about how we're implementing that approach.
Hi, I'm Gina Peters. I was in academia for over 10 years, Trinity University, and then University of Chicago in economics, and then did some consulting as well with central banks and governments on CBDCs and stablecoins. And then Nevin convinced me that there'd be some really interesting and meaningful questions to work on at Confusion Capital with an actual impact. I've been here now for 2 months, and it's been true. So I'm going to be building on this entire question, and I'm going to be looking at how would we construct this portfolio programmatically, right, using code. This is good for transparency and decentralization and really helps us down the line potentially integrate more with DeFi markets. So my overall goal is to develop a programmable rule set that we can use to generate a portfolio every month using only data that's available prior to that month. Right, so we want to make it as automatic as possible, and in this particular phase of the project, realize where do we still need human input. So just to bring, sort of to make something just tangible for everyone, when we say the word portfolio, I have to design a portfolio. Like, what do I have to do? I have to choose assets, and I have to choose the weights of those assets that sum to 1. So this is an example of a portfolio. It has 4 assets, and those assets all have equal weights of 25%. If I change the weights, or if I change the assets, that becomes a new portfolio. So my code has to choose assets and the weights for every single month. The programmatic approach I'm taking doesn't try to predict inflation or asset prices. Right? I'm not going to do that. Instead, we're going to rely on a pattern of asset return and inflation co-movement in recent history. Right? So we're going to exploit the fact that when these asset prices have moved, they have typically moved in a way that reflects inflation. Now, some of you might think, does that mean I'm choosing assets that have, if inflation goes up by 1%, the asset price goes up by 1% as well? No. All right, suppose here my prices are increasing and maybe at a rate of 1%. Right, I have an asset here where the price of that asset is going up by 2%. Right, so every time inflation goes up by 1%, the asset goes up by 2%. It goes up by double inflation. And then here, asset 2, it's growing at half the rate of inflation. What I can do is if I take the first asset and the second asset in equal proportion, so 50-50%, that combination of assets yields me a portfolio, right, 2 assets, 2 weights, that will increase and grow at exactly the rate of inflation. So I can combine more and more assets with more and more different weights so that they continue to follow inflation. And what that ultimately results in is a diverse portfolio. We've got diversification happening. So if one of these portfolio assets decide, I don't want to follow inflation anymore, that's okay. The others hopefully will pick up the slack. So that, again, as Eric was saying, reduces risk from dominant assets. So what assets are going to be in this portfolio? So every month, I'm going to construct an asset pool. All right, so my asset pool is going to have some always-in assets and some assets selected for that month. And by the way, here when I say the word assets, I am just talking about ETFs for this particular incarnation of the project, which, as Chelsea said, it's to get everything nice and tractable. So we identified about 4,000 ETFs we could get data for. And out of that 4,000, about 890 satisfied the design restrictions Eric mentioned. Those design restrictions are in place for my portfolio as well. Every month, I could identify between 15 and 37 ETFs to include in the portfolio. So 15 ETFs are always in. Right, so these are a combination of the intuitive and programmatic approaches. Essentially, some of these assets are ones that we just saw showing up a lot when I was running correlations. Right, they just are very frequently correlated with inflation, so we included them nonetheless. Others come from Eric's barbell approach intuition. So again, there's this human element right there that we flag. And then finally, Bitcoin and gold are always in, again, because of this consideration with debasement. And they always have to have a minimum of 5% weight. Other assets that are in, whether they are the always in or the selected, those weights, even though they're in, they can be 0% weights. So just because they're being considered doesn't mean they have to be included. So in addition to the 15 ETFs, we have our correlated assets. Every month, there are between 0 and 22 correlated assets. So these 0 months, which existed, as we learned, that's why we need these always-in ETFs, to have not just Bitcoin and gold, but to have some additional assets in there. Overall, out of the 890 ETFs that were feasible to include, 236 are identified as being highly correlated for at least 1 month in the sample, if not more. So that's actually a lot more than we expected to find. And again, part of that is because I'm not saying you have to have a one-to-one correlation. You just need to have a correlation with inflation. All right, so now I have this pool of assets between 15 and 37 every single month. And now the real task of the model begins. Right, so in the simple example where I had just 2 assets, that 50-50%, right, that was easy, we could see it, that had to be what it is. When you have 37 assets, right, how do I combine these assets, especially because the lowest weight on any individual asset is 5%, which means I can have at most 20 assets in that basket at any given time. Right, so I can't just include all of them. I have to pick which ones I'm including and what weights I give them. So given the asset pool for that month, the program is going to select the asset weights so that the construction portfolio closely tracks past inflation. So let's suppose this is May 2025, over here. It's going to look back a number of months and choose weights and fix them so that the portfolio that it's created most closely follows inflation. So it's going to look across a whole bunch of possible weights and then choose the combination of weights that best follows inflation historically. And we're going to use that for just 1 month, and then we'll rebalance. I'll just mention quickly at this point, we're not considering trading fees right now, but I can incorporate that once we get a better handle of those. But for now, we're assuming we're going to do monthly rebalancing if necessary. All right, so portfolio looks back, does the best it can, and then we're going to have that for 1 month, and the next month, again, same procedure, look back some number of months, do the best we can, and that's our new portfolio every single month going forward. Now, here is the technical slide. All right, so that statement in English that says, select asset weights so that the portfolio closely tracks past inflation. Right? That is nesting a whole bunch of human understanding that computers just don't get. Right? So computers need this to be a mathematical phrase. So what does that sentence mean in math? What does it mean to closely track inflation? So essentially, in this picture, very nicely, right, I could combine these 2 assets and they would perfectly track inflation. That doesn't happen in the real world with real-world asset prices. It never perfectly tracks inflation. It's going to deviate. It's going to move away from that inflation line. So how do I figure out how I'm going to tackle those deviations? Am I going to penalize that past track record, whether it's positive or negative deviation? How about big deviations versus small deviations? So essentially the volatility. Suppose I've got 10 months of data, and I look back and I've got a portfolio that's moved 1% away from inflation for 5 months. And I've got another portfolio that over those 10 months has moved only moved away from inflation once, but that one time it moved 10% away. Right? Which one of those 2 portfolios have better performance? Which happens, what if I look back and I see, well, recently this is done very poorly, but 2 years ago this was great. Right? How do I balance recent deviations versus past deviations? Every single one of those sort of intuitive understandings actually comes with a mathematical formula that we can use to assess and penalize, right? So it's absolute values, square of differences, the weighted squares, and so on. You'll notice I've been pretty hedgy about how far back we look. It turns out that's also a choice, right? Do we say how well you've done the past month? Do we look back and say, okay, for the past 12 months, 6 months? And then this other thing about limiting the size of the portfolio composition changes. So right now we're not thinking about how much it will cost to change portfolio. But the thing with this backward-looking approach is it does ignore some basic finance rules, which is that frequently, if the price of an asset goes down, which means it takes up less weight in our portfolio at the end of the quarter or of the month, it's likely to revert back to the mean and go back up again. And that will help compensate for that removal away from inflation. So maybe instead of the code freaking out and saying, okay, sell it because it's moved in a bad way, we want to tell the code, no, just chill for a second. And so that's called portfolio stickiness. So these are all three considerations that I want to put into math that captures the idea of the sentence at the top. So one example of a rule set that I can give to the code is to say, hey, choose my asset weights that minimize the absolute value of the difference between that growth of the portfolio and inflation, or the growth in prices, for every single one of the past 12 months. And while you're doing that, don't allow the asset shares in the portfolios to change more than 5% from the actual portfolio we gave you that we implemented last month. Right, so I'm standing here at the end of March, I have a portfolio that I gave it, and I say, hey, choose me a new portfolio that minimizes the absolute deviations for the past 12 months, but also don't move more than 5% for every single one of the assets that I began with. That's one rule. Every single one of these bolded, underlined texts can be changed, right? Chelsea calls them the sliders, right? So instead of 12 months, it can be 8 months or 11 months. Instead of 5%, it can be 10%, right? Instead of absolute value, it can be weighted squares or whatever else I want to consider. So if you keep playing around with that, you've got about 2,300 combinations of rule sets. And every single one of those can create a sequence of portfolios for every single month. And then I have to go in there and I say, okay, well, out of these 2,300 different rule sets, which one does best? Right, so to give you a sense, this is 2,300 portfolio that have been generated through these different rule sets. And you can see, again, like Eric was saying, this one goes up to almost $5,000 there from a portfolio of 10K. So that one's terrible. We don't want to use it. There is no rule that says I have to use only one rule. So I could say, hey, use this rule while you're doing well. But you know, what if things go bad? What if you're growing at less than 2% than inflation, then you're doing poorly. Now you can choose a new rule. So that's a trigger shift. So now I've got 2 rules to consider, and now we have 5 million options. But there's also no rule that says I can only need to consider one trigger strategy. I could have 3 rules, right? So that's 12 billion. I could, 3, 4, 5. You can keep going on with these trigger strategies that trigger on different past performances. Our current winning rule set, the default is to minimize the square distance from inflation for the past 7 months, which both penalizes over and underperformance, but interestingly enough, penalizes overperformance more, and then changes composition by no more than 11%. If real returns in the past month are below 2%, then you shift to this rule that, this is technical, but maximizes the lowest excess returns over the past 12 months, so the months have shifted, carrying over from assets from the prior month, but not imposing any portfolio stickiness at all. So then you can change a lot, which surprised me. It's not what I walked in expecting. But that is indeed the best performing portfolio, or best performing rule set to generate portfolios. Considering only one trigger strategy, I couldn't handle 2 in the time that we had. All right, so how does my June 2025 portfolio compare to Eric's? I think it's very important to acknowledge his is a static portfolio. He's chosen it once and run with it. We've run it back through time. Mine gets generated every single month. So this is the portfolio that I have specifically generated for June 2025. As you can see, Bitcoin and gold, that very minimal inflation relationship means they are both set to the absolute minimum I can get away with, my code can get away with. Interestingly enough, both of us include foreign governments in our portfolios. Eric goes in through foreign currencies. I go in through the combination of sovereign debts. Corporate debts, Eric has 25%, I have 40%. Essentially what he puts into the required assets, my code puts into the corporate debt. US and global equities, I found that paper you were citing in the morning, Larry, very interesting, because again, that 20% is what seems to be maximizing for both of us. And then Eric picks up the energy assets, which my code does not pick up for June. Because I get a new portfolio composed every single month, we can actually look back and see what was generated every single time. So I don't have any energy assets in June 2025, but you see these ones in red, that's where the portfolio picks up some energy assets in there, the uranium one specifically. Corporate bonds are these green bars, so you'll see those pick up every now and again. Here, this section is sort of pre-COVID. This section is COVID. This section is the high inflation period. And you can see those corporate bonds became very, very popular in the program during the high inflation era. And now we're back to essentially what we had pre-COVID. The brown, that's sovereign bonds. Again, popular now, most popular it's ever been. Down here, this orange line, that's Bitcoin. Portfolio never wants to hold Bitcoin, except for these very few cases where it does. On the other hand, it does not mind holding gold. That's the yellow line. You can see that gold line pops up occasionally. But interestingly enough, and this has been a point of discussion, sort of side mention in some of the talks, how much is gold an inflation hedge? According to the program, not very much. It doesn't get picked up often, but it does get picked up during COVID. So the portfolio composition actually changes a lot, right? Not just the assets themselves, but which industries those assets are affiliated with. All right, so you've seen this graph a few times now. That's the intuitive portfolio, which again, it's sort of unfortunate because it's locked into performance. Mine, which allows it to change every single month. So as you would expect, relative to inflation, mine does better. It has its maximum deviation around here. It's 8% higher than inflation, just reading in a line. And then its lowest performance relative to inflation, it's 8% below inflation in value there. Average, it's above. So if I look down this sovereign wealth fund, this line, it's about 0.5% above. Eric's obviously, if you're looking for returns, his is considerably higher. But this line kind of obscures an important point, right? We're not trying to save wealth, right? This is the common visualization of it. But we really want this to be a currency. So we don't want people to have to buy and hold for 5 years to break even. We want you to be able to put in money this month and take money out next month and not lose due to inflation, right? So we haven't actually, none of the charts we've shown you help you do that. So how can we look at that? I'm not going to show you that chart because it looks incredibly scary. I'm just going to summarize what we say. And so what we're going to look at is essentially the growth rate. How much does inflation grow from month to month? And compare that to how much did the portfolio grow month to month. Because if your growth rate exceeds inflation, right, you've gained. If the growth rate is below inflation, even if it's positive, but if it's grown less than inflation, you've lost real value. So how do these two portfolios do? Well, overall, we both have our ups and downs. This is during the high inflation period, so mine gains less value and loses less value than the intuitive portfolio. Our average difference and our median difference is positive. So that means that we grow above inflation. Again, by targeting, mine grows less above inflation than Eric's does. A number of months below inflation. So how frequently are you 1% or less below inflation? Again, you might have positive interest. Or maybe your interest rate is 2%. But if inflation is 3%, you've lost in real terms. So Eric spends more time down there than I do. However, if you just think about any negative return, right, I spend more months there than he does. You more frequently have negative return with a programmatic portfolio. Why is that? Because I'm trying to stick exactly at inflation, so I'm bouncing around that inflation line a little bit more than he does. But I still average out to be positive. So to go back to the question of can we build a programmatic portfolio that tracks inflation? The answer is overall, yeah. It seems like we can, which is nice. And we can do as well, if not better, than other portfolios with similar inflation tracking goals. We can automate the selection of assets and weights. That's really what the programmatic approach means. But there are still some event-specific robustness of the automation that's not clear. So think of all those assets we had to manually include, right? And the fact that here, during the high inflation period, we do see this drawdown, this performance below inflation, which was common across assets of portfolios of similar types. But that's still 5% loss in a month, which is not great, one would think.
Okay, so can you hear me? I'm not used to, okay. I'm gonna wrap us up with some lessons that we've learned and some questions that we wanna answer, and then open it up for some discussion. So we did learn that even with the fairly stringent design restrictions that we have, right? Like only considering ETFs, throwing out anything that holds US government debt, not using TIPS, which is sort of the go-to inflation-proof asset, we are still able to develop portfolios that perform well when we plot them against other inflation-focused products. So that's exciting, and we're excited to continue adding more assets. Gina mentioned this, but we found more ETF assets. We started with only about 4,000, and 230 of them did have statistically significant correlations with inflation. In our short look-back period, right? We're not looking back that far. So that was a good outcome, and we think that as we expand into more assets, we'll probably find more that we want to consider. That said, I think last Monetarium, there was a lot of discussion about, like, wouldn't it be great if we could just develop a single spot portfolio of assets that stay in the portfolio? Maybe we just, rebalance them a little bit. But, in some months, we found no assets in this pool that had a correlation with inflation. So that kind of suggests that that might not be possible. We also learned that, this underlying mandate of making an inflation tracking portfolio is unique. Aside from TIPS, we didn't encounter something else that's really trying to do that outside of the crypto asset space, in the traditional finance assets that we're looking at as a benchmark. We also learned that Bitcoin and gold kind of worked as an insurance for this portfolio. Insurance is maybe not exactly the right word, but this is just a chart that's showing you the return contributions by asset class in the portfolio. This is Gina's programmatic portfolio that's shifting month to month. So you can see that, it's Bitcoin and gold that are sort of lifting that portfolio back up towards the inflation line, and the other assets are not producing as extreme of movements. So for our next steps, data was actually a surprising challenge for this analysis. If you happen to have a Bloomberg terminal in your pocket or a really large data set for me, I would love to know that. So anyway, we want to expand with better data, data about fees, data about further assets. And as Gina mentioned, we sort of ran up against the limitation of what we could do with a laptop in the couple of months leading up to Monetarium. So we're going to need to explore taking this into the cloud and doing some of the computing there as we include more variables and have to iterate through more portfolios. So yeah, we want to expand the analysis, equities, crypto assets, international assets. We want to consider more inflation benchmarks than just US CPI. And of course, as you saw, we've only been looking back to 2018. So we want to figure out how to, that's a limitation of ETFs, right? That was talked about, Richard Evans talked about that earlier, where they just don't have that long of a history. So we have to think of how we might extend back testing or do more modeling to understand how this portfolio would perform. We'd also like to apply this method to alternative approaches. Instead of just targeting aggregate CPI, it would be really cool to target inflation components and then combine those into a portfolio. So you could have a portfolio that tracks the different components of the CPI, and then the weightings of the final portfolio would simply be how CPI weights that basket. We also could, in theory, get closer to targeting personal inflation that way, which would be pretty cool. There's some open questions from this analysis. Some questions that are specific to the portfolios that we showed you. we don't really know what the impact of trading costs and rebalancing fees are going to be on the programmatic portfolio. We just didn't have time to bring those in. If you have any intuitions about that, we'd love to hear them. We don't really know how often the intuitive portfolio will need to rebalance. You know, Eric was at kind of a disadvantage here because we can't mimic historically that active management decision making, so he's going to have to learn as we go forward what choices he's going to make month to month, and that's going to be an exciting way that this will develop. Similar to that point, it's going to be interesting to sort of watch these two approaches converge or diverge as we begin to manage these assets. So last of all, sort of zooming out, feel free to ask us about like the specifics of methods or assets or things like that, but some big picture questions that have occurred to us as we do this. How closely does an asset-backed currency really need to track inflation to satisfy users? Gina talked about this in math, but it's really a difficult question. Like, think about what would you be satisfied by? How close do you have to get to inflation to call yourself an inflation tracking portfolio? And also thinking about something that Mark Dinner said yesterday, money is, in a lot of ways, culture and faith and things like that. So as you think about these portfolios, and whether you feel like maybe they feel like money or maybe they don't, what non-money characteristics would be necessary for adoption of such a currency in the long term? Thank you for listening to us.
Hello, hello. So we do a lot of rebalancing, and one of the biggest issues in my niche part of the industry is automating liquidity within these on-chain markets so that when, for instance, the rebalances happen for DTFs, that there's not massive slippage either on the minting side or even on the swap side, basically, right? And one thing that we've had to develop is basically a simulation where we fork the blockchain, bring it locally, and then replay every transaction to figure out what is the actual market impact of different stuff if I was in the market at that time in the past, right? And another problem that I think you guys are hitting that we also hit was data collection, right? And if this does become permissionless, or if I do have the situation, how do I have access to that data? It's always backward looking and stuff like that. So that's very interesting. I'd love to maybe talk to you guys about that. And then in regards to, you're always backward looking. One thing we've done with another company called Allura was say, okay, you guys have about 10 or 20 models. Let's put those into an ensemble, run a little bit of machine learning, and then have that computed value. So you could potentially have multiple CPI tracking rule sets that then go into another model, which then kind of condenses them into an aggregate, if that makes sense.
Yeah. We'd love to talk more.
Did you look at the effect of the starting portfolio, given that you had like stickiness as like one of the requirements for the calculated portfolio?
Yeah. So we didn't get into how the various rule sets were chosen, but looking at robustness to that starting point portfolio was a huge one. And so we kept showing the charts that had the aggregate growth from 2020 just to be consistent with data formats as people typically looked at them. Actually, can you show the month-to-month changes? What I was looking at a lot of time, other way in the supplementaries, what I was looking at a lot of time when I was doing this programmatic approach is actually this chart here, which is the month-to-month performance, which is this question of the higher frequency, how much is the portfolio changing on that month-to-month level? Because that's, again, if we want to go for a currency as opposed to a evergreen fund, we need people to be able to enter and exit at high frequency. So how can we minimize, like what rule set minimizes that jumping around, essentially, at the end of the day? That was a big component as to who wins. And so when you do that view, the starting point doesn't matter anymore, right? Because I'm looking at like every single month you enter and every single month you exit.
I have a bunch of things to discuss with you guys. We can do it afterwards. But one thing that comes to mind is a tax issue. Because with rebalancing, you're generating a giant tax liability, which will drag down the performance in a big way.
And so when I was designing the programmatic approach, I actually, I'm doing convex optimization over a constraint set. And so I can actually add in taxes and fees as part of that optimization routine, which my suspicion is it's going to make everything less swingy. Like right now it swings a lot because it doesn't have to consider the additional loss to the portfolio that would happen due to this rebalancing. But right now, we don't have a sense of what those trade costs will be. So like Chelsea said, this is going to go live, and we're going to start learning that a little bit better, and then I can update the code to include that, and we'll see exactly what it does. And that can be one of those things that gets Oracle fed in, hopefully, down the line, and then just get incorporated into that algorithmic rule set. But once I have cost set, that might change what the optimal algorithm is, again. So that's our current winning rule set, but down the line, there might be a different winning rule set once we bring in those trading costs.
Yeah, just the one thing with that is you might want to look at longer periods to maximize, because you're running into 1 month rebalancing. That compounds negatively.
So the rebalancing, whether it rebalances at all, is automatic. Right. It doesn't have to. It doesn't have to rebalance. That's what I'm saying. Yeah.
I think we are out of time, but we would love to talk more. If you want to find us after, we'll let the next session get set up.